If you're holding a 401k, cash savings, treasury bonds, Japan ETFs, tech stocks, gold, or literally any dollar-denominated asset right now, what I'm about to show you affects your purchasing power in the next 30 days. The Japanese yen just hit 152 against the dollar. That's a level we haven't seen since the interventions of 2022. And here's the kicker. Japan's finance minister gave a statement 48 hours ago using the exact same language they used right before they burned $60 billion defending the yen last time. This isn't about Japan. It's about the global interest rate machine that controls bond yields, mortgage rates, and whether your portfolio goes up or gets quietly eroded. Most people think this is just currency stuff. What most people missed is that when Japan moves, the entire carry trade unwinds, and that trade is sitting underneath your index funds, your bond duration, and your cost of living. Let me show you. By the end of this video, you'll understand three things. 1. Why the yen hitting 152 is a symptom of a much bigger structural problem in global markets, one that directly impacts US Treasury yields and equity valuations. 2. The mechanism behind the carry trade, why it's unwinding right now, and what that means for volatility in your portfolio over the next 60 days. And 3, a practical action plan, not advice but a framework for how to position, what to watch, and how to protect yourself without panic selling or doing something stupid. This is not a prediction, this is a pattern, and if you know the pattern, you can make better decisions than 95% of people who are flying blind right now. Let's start with what happened in the last 72 hours. 3 updates in the last 3 days. Update 1, the yen weakened past 152 per dollar on Tuesday. That's the weakest it's been since July 2024, when Japan intervened in the currency market. Update 2, Japan's top currency diplomat, the guy who literally controls intervention, said they are watching FX moves with a high sense of urgency. That's diplomatic code for we're about to do something. Update 3, US 10-year Treasury yields spiked back above 4.5% this week, driven by sticky inflation data and strong job numbers. That makes the dollar even stronger relative to the yen. Now, if you're not a currency nerd, you might be thinking, why do I care about Japan's currency? Here's why. Japan is the largest foreign holder of US Treasuries. They own over $1 trillion of our debt. When the yen weakens, Japanese investors have to decide, do we sell US bonds to defend our currency, or do we let the yen collapse and import inflation? Either choice creates volatility in US bond markets, and bond market volatility bleeds into everything: mortgage rates, corporate borrowing costs, equity valuations. In a minute, I'll show you the carry trade mechanism that makes this 10 times more explosive than it sounds. But first, let's talk about why this is happening now. Let's rewind 6 months. In 2024, Japan finally started raising interest rates after decades of zero and negative rates. The Bank of Japan moved their policy rate from minus 0.1% to 0.25%. Sounds tiny, right? But here's the thing. The US Federal Reserve has rates at 4.25% to 4.5%. When you have that kind of gap, investors do something called the carry trade. Let me explain it like you're 8 years old. Imagine you can borrow money in Japan at 0.5% interest. You take that cheap yen, convert it to dollars, and buy US treasuries that pay you 4.5%. You pocket the difference, 4% risk-free, well, almost risk-free. The risk is this: if the yen strengthens, your loan gets more expensive when you convert dollars back to yen. You lose money on the currency move, even if the bond trade works. For years, this trade was free money. Japan kept rates at zero, the dollar stayed strong, and hedge funds, banks, and even pension funds piled in. But now, the yen is collapsing, the dollar is strengthening, and the carry trade is starting to unwind. In a minute, I'll show you what happens when trillions of dollars in carry trades unwind at the same time. Spoiler, it's not pretty. But first, let's bust a myth. Myth: currency moves don't affect me. I don't trade Forex. Reality: if you own an S&P 500 index fund, you own multinational companies. About 40% of S&P 500 revenues come from outside the US. When the dollar strengthens, which it is right now, US companies earn fewer dollars on their foreign sales. That hits earnings, that hits stock prices. Apple, Microsoft, Google, they all report earnings in dollars. If the yen collapses, their Japan revenue shrinks when converted back. So yeah, currency moves absolutely affect your 401k. They're just invisible until earnings season, and by then it's already priced in. All right, let's go deeper. What are the pros actually watching right now? If you follow macro Twitter or finance YouTube, you've probably heard the term volume spike or VIX pop. Let me connect the dots. When carry trades unwind, here's the chain reaction. Step 1. Yen strengthens suddenly, or speculators think it will. Step 2. Traders sell US bonds and buy yen to close their positions. Step 3. Bond selling pushes yields higher. Step 4. Higher yields make borrowing more expensive and hit equity valuations. Step 5. Stocks drop, volatility spikes. This exact pattern happened in August 2024. The yen spiked from 161 to 142 in 2 weeks. The VIX, the fear index, jumped from 12 to 65. The S&P dropped 8% in 3 days. Now, we're not in that scenario yet, but the setup is similar. Here's what the pros are watching right now. 1. The 152 level on USD JPY. If we break above 155, intervention becomes almost certain. 2. The 10-year Treasury yield. If it breaks above 4.6%, that's a new macro regime. Higher for longer is real. 3. Japan's official FX reserves. If they start declining, that means intervention is already happening quietly. In a minute, I'll show you the historical example that explains why this matters for your portfolio. But first, let's bust another myth. Myth: Japan can't afford to intervene. They'll just let the yen fall. Reality: Japan has over $1.2 trillion in foreign currency reserves. They burned $60 billion in 2022 defending the yen, and they didn't even blink. The bigger issue isn't can they intervene, it's will it work. In 2022, their interventions lasted a few weeks, then the yen weakened again. Why? Because the interest rate gap didn't close. This time the gap is even wider. The Fed isn't cutting as fast as markets hoped. Japan is raising, but slowly. So the question isn't will Japan intervene, it's will intervention even matter, or are we just adding volatility? Let me show you a historical example. In 1998, Japan faced a similar situation. The yen collapsed during the Asian financial crisis. The Bank of Japan intervened multiple times. It didn't work. Why? Because the structural problem wasn't the yen, it was global risk appetite and interest rate differentials. Eventually, the crisis forced the BOJ to adopt zero interest rate policy for decades. That's not a solution, that's surrender. Now, I'm not saying we're in 1998. The global economy is different, but the pattern is instructive. If Japan intervenes and it fails, the next step is policy panic, rate cuts, more QE, or coordination with the Fed and ECB. And if that happens, everything changes. Bond yields, inflation expectations, currency stability, all of it gets repriced. All right, you're probably thinking, okay, I get the mechanism. What does this mean for my money? Let me break it down. Let's break this into scenarios, not predictions. Scenarios. Scenario A: Japan intervenes, yen stabilizes, carry trade stays calm. Result: markets breathe, treasury yields drift lower, equities grind higher, volatility fades. This is the soft landing version. Scenario B: Japan intervenes, yen pops briefly, then weakens again. Result: volatility spike, 5–10% equity correction, traders take profits, bonds get choppy. This is the mini August 2024 version. Scenario C: Japan doesn't intervene, yen breaks 155, carry trade unwinds violently. Result: major volume event, 15–20% equity drawdown, bond yields spike first, then collapse as investors flee to safety. This is the oh shit version. Which scenario is most likely? Honestly, I'd put scenario B at 50%, scenario A at 30%, scenario C at 20%. But here's the key. Your portfolio positioning should account for all three. In a minute, I'll give you a decision framework for how to think about this. But first, let's bust one more myth. Myth: I should sell everything and go to cash. Reality: timing the market is nearly impossible, and cash loses to inflation. Look, I get it, volatility is scary, but selling at the first sign of risk is how you lock in losses and miss the recovery. The better approach: position sizing, diversification, and clear risk rules. Let me show you. All right, here's a framework. This is not financial advice. I'm not your advisor. I don't know your situation. But this is how I'd think about positioning if I were managing my own portfolio right now. Step 1. Know your time horizon. If you're retired or retiring in the next 2 years, you need liquidity and low volatility. You can't afford a 20% drawdown. If you're 10 plus years from retirement, volatility is noise. Stay invested, rebalance on dips. Step 2. Adjust your duration. If you're holding long-term bonds, 10-year, 20-year, consider shortening duration. If yields spike, long bonds get crushed. If you're in bond funds, look at your fund's average duration. Above 7 years, that's high risk right now. Step 3. Diversify currency exposure. If 100% of your portfolio is in dollar-denominated assets, you have concentration risk. Consider adding international equity, Europe, emerging markets, commodities like gold and energy, currency hedged funds. Step 4. Watch these levels. USD JPY, 152 is the line. Above 155, intervention is near certain. 10-year yield, 4.6% is the breakout level. Above that, we're in a new rate regime. VIX, if VIX spikes above 20, volatility is here. Above 30, it's a risk-off event. Step 5, risk management checklist. Don't use leverage, don't chase momentum, don't panic sell, do rebalance if your allocations drift. Do keep 3-6 months of cash for emergencies. This isn't sexy, it's not 10x your portfolio in 30 days, but it's how you survive volatility without losing sleep. Alright, let me give you one more example, then we'll wrap. In August 2024, the yen spiked 12% in 2 weeks. The carry trade unwound, the VIX hit 65, everyone panicked. This is the crash, sell everything. Then it reversed, the S&P recovered within a month, the yen stabilized, volatility collapsed. The lesson: volatility events are sharp, but often short-lived. If your portfolio is diversified and you don't use leverage, you survive. The people who sold at the bottom, they locked in losses and missed the bounce. Alright, let's wrap this up. Here's what we covered. The yen hit 152. Japan is watching with urgency. The carry trade is under pressure. Treasury yields are spiking. Volatility could follow. This isn't doom, it's a pattern, and patterns create opportunity if you know what to watch. Here's the thing, everyone is watching the yen like it's a crisis, but the real story is this: when Japan moves, the world's bond market moves. And when the bond market moves, your 401k, your mortgage, and your cost of living all move with it. So here's what you do next. Check your portfolio's duration. Check your currency exposure. Set your watch list for 155 on USD JPY and 4.6% on the 10-year yield. And if you want to stay ahead of this stuff without checking Bloomberg every hour, hit subscribe. I break down macro moves like this every week. No hype, no BS, just the signal you need. Thanks for watching. I'll see you in the next one.